The financial media has gone quiet. And when I say quiet, I mean the kind of silence that makes you check if your internet connection is still working. Welcome back to Silver Street. As of morning, February 8th, 2026, the mainstream narrative has officially shifted to "the silver bubble has burst." Headlines everywhere. Bloomberg, Reuters, the usual suspects all running the same script. Silver crashed from $121 per ounce in late January to below $70 at the lows. A 40% collapse in less than 2 weeks. And according to every talking head on television, price discovery is back. The speculators got wiped out. The casino is closed. Move along, nothing to see here. They're pointing to guys like Bian Ximing, the so-called gold king, who built a 30,000 contract short position and walked away with a $288 million paper gain. They're saying traders like him broke the silver bulls, that the crash was a rejection of value, that the fundamentals never supported the rally in the first place. But here's the thing. I've been analyzing commodity markets and stacking physical silver for 12 years now, and I can tell you with absolute certainty, the screen was lying to you in January, and it's lying to you right now. Because while the price was plummeting, the physical bars were vanishing at a record pace. The vault data tells a completely different story than the price chart. And it's not a story of speculators getting crushed. It's a story of an emergency rescue mission by the bullion banks. They want you to believe the crash was organic, that it was natural market forces reasserting themselves, that the fundamentals finally corrected. But to understand the illusion, you have to look at the one place no one expected the banks to rob, their own ETF. Let me be direct about what I'm claiming here. The bullion banks, JP Morgan, HSBC, the usual London suspects, used the SLV ETF as a liquidity valve during the January price spike. They drained physical metal from that fund to satisfy delivery demands on other exchanges, primarily COMEX and Shanghai, to prevent a total systemic default. This isn't speculation. This is what the data shows when you actually look at it. And the two smoking guns that prove this shortage is accelerating, despite the lower price, are what I call the SLV drains and the lease rate spike. In this briefing, I'm going to walk you through the exact mechanism of silver lease rates. I'm going to run the math on the massive delivery wall that's hitting on March 1st. And I'm going to share exactly how I'm personally positioned as the physical market and the paper market finally decouple. Because this isn't just about a trade. This is about the integrity of the global pricing system for precious metals. And that system is breaking in real time. If you're watching this channel, you already know that the AI avatar you're seeing is just the delivery system. If you want to know who's actually behind this analysis, check the channel intro on the homepage. But right now, we don't have time for backstory. We have work to do. Because the situation on the ground is evolving hour by hour, and what I'm about to show you is intelligence that most market participants won't understand for weeks. You're getting first mover intel here. Treat it accordingly. Let me give you the raw numbers exactly as they stood when I was looking at them early this morning. Silver was trading at $77.55 per ounce. That's up 15.5% from the previous session's lows. So we got a bounce, a dead cat, a reversal. We'll come back to that. Gold was sitting at $4,962.77, up over 5.5%. Both metals staging what the media is calling a technical rebound after getting absolutely obliterated in late January. But here's where it gets interesting. COMEX registered inventory, the physical silver that's actually available for delivery, was sitting at 103 million ounces. Open interest for the March contract, over 400 million ounces. You see the problem yet? Combined Chinese stocks across the Shanghai Futures Exchange and the Shanghai Gold Exchange were at a critical low of less than 30 million ounces. Now, let me put this in context. While the paper price was crashing 40% in late January, the physical delivery notices in just the first 5 days of February totaled 19 million ounces. 19 million ounces in 5 days. That's nearly matching the entire delivery volume for February of 2025 in 120 hours. If this was a genuine supply glut, if the fundamentals truly supported a 40% price crash, why were delivery requests accelerating at 4 times the normal pace? Stop. I want you to really think about this for a second. The narrative says the crash happened because there was too much supply and not enough demand. That's how crashes work in commodities, right? Oversupply kills the price. But if that were true, physical delivery demands should have been collapsing. Buyers should have been walking away. The vaults should have been filling up with unwanted metal. Instead, the opposite happened. Here's the part that should terrify anyone who understands how ETFs are supposed to work. Between December 22nd, 2025 and January 30th, 2026, 35 million ounces of physical silver left the SLV vaults. 35 million ounces during a period when the price was moving up initially, then crashing violently. Now, in theory, when the price of an ETF drops, You might see some outflows as investors sell their shares. That's normal. But the mechanism is supposed to work both ways. When the price rises, inflows should increase. When it crashes, outflows should slow down because bargain hunters step in. That's not what happened here. The outflows were relentless, regardless of price direction. And here's what most people don't understand about the SLV redemption process. When an authorized participant redeems SLV shares for physical bars, they're not doing it because they want to hold silver as an investment. They're doing it because they need to deliver physical metal somewhere else. The banks weren't selling their silver. They were moving it to keep the lights on, and those lights are starting to flicker. All right, let's slow down here and get into the teaching mode. Because if you don't understand lease rates, you're not going to understand why this situation is terminal. A silver lease rate is simply the annualized cost, the interest rate, required to borrow physical silver bars. Think of it like this. If you're a bullion bank and you have a vault full of silver, you can lend those bars out to industrial users, other banks, or market makers who need physical metal for short-term operations. In exchange, you charge them a fee. That fee, expressed as an annual percentage rate, is the lease rate. In a normal, healthy market, lease rates are near zero, maybe 0.25%, sometimes even negative if there's so much metal sitting around that banks are willing to pay someone to take it off their hands temporarily. When lease rates spike, it means someone is desperate for metal right now and cannot wait for the standard delivery cycle. Let me give you an analogy that'll make this crystal clear. Imagine a car rental lot where rentals normally cost $50 a day. The lot has plenty of inventory, everything's fine. Then one day, the lot is empty. Every car has been rented out. And now there's a line of people willing to pay $500 just to borrow a car for a few hours. The official price of a used car might actually be falling on Craigslist at the same time. Maybe there's a recession and people are selling their cars cheap, but that rental price, that $500 desperation bid, that tells you there's a catastrophic shortage of actual vehicles on the ground right now where people need them. That's what a lease rate spike is. It's not about the long-term value of silver. It's about the immediate physical availability of bars in the vaults. The Friday spike that changed everything. On Friday, February 6th, the silver lease rate spiked to 6.3%. 6.3%. Let me put that in perspective. For most of the last decade, silver lease rates have hovered between 0 and 1%. A spike to 2% would be notable. 3% would be alarming. 6.3% is a 5-alarm fire. And here's the kicker. This spike happened after the crash. The price had already collapsed from $121 to the mid-60s at the lows. If the crash had genuinely solved the supply problem, if there really was too much silver and not enough demand, then lease rates should have been collapsing too. Instead, they went parabolic. This tells you everything you need to know about what's really happening beneath the surface. The paper price is being manipulated lower through margin hikes, forced liquidations, and coordinated short attacks. But the physical market is in an absolute scramble. Banks are paying 6.3% annualized just to borrow silver bars for short-term delivery obligations. That's not the behavior of a market in surplus. That's the behavior of a market on the edge of default. And if this rate hits double digits, the paper price won't just be wrong, it will be completely irrelevant. All right, let's get into the numbers that keep me up at night. As I mentioned earlier, COMEX registered inventory is sitting at 103 million ounces. That's the physical metal available for immediate delivery. Open interest on the March contract is over 400 million ounces. Now, in a normal market, the vast majority of futures contracts get rolled forward or closed out before delivery. Most traders are just speculating on price. They don't actually want 50,000-ounce bars showing up at their doorstep. But let's run a conservative scenario. What if only 25% of those March contract holders demand physical delivery? That's 100 million ounces. The registered vaults have 103 million ounces. You see the problem? If even a quarter of the longs stand for delivery, the COMEX vaults would be nearly wiped out. And that's assuming zero delivery demand from other contract months, which is obviously not realistic. Now let's stress test this even further. In the first 5 days of February, delivery notices totaled 19 million ounces. If that pace continues through the end of the month, we're looking at over 100 million ounces in delivery requests for February alone. And then March hits. The available LBMA free float, the total amount of physical silver available in the London vaults for immediate allocation, is estimated at around 150 million ounces. Some estimates put it lower. So even if you pool London and New York together, you're looking at maybe 250 million ounces of deliverable metal in the entire Western banking system. The delivery demand we're seeing right now is pacing at 4 times last year's rate. The math doesn't work. The paper market is pricing silver at $77, but the physical delivery demand is screaming that there isn't enough metal to go around. Here's where the bullion banks got creative. When delivery pressure started building in December, they couldn't just let the COMEX vaults drain to zero. That would have triggered a panic. It would have broken the entire illusion that the paper price represents real available metal. So what did they do? They turned the SLVETF into an ATM. Between December 22nd and January 30th, 35 million ounces left the SLV vaults. The banks, acting as authorized participants, were buying SLV shares on the open market, then redeeming those shares for physical bars, and then moving those bars into COMEX or LBMA vaults to plug the holes. This is not a conspiracy theory. This is a documented process that's completely legal under the SLV prospectus. The authorized participants have the right to redeem shares for physical at any time. But the purpose of that mechanism is supposed to be arbitrage. It's supposed to keep the ETF price in line with the spot price of silver. What we saw in December and January was something different. The banks weren't arbing a price discrepancy. They were draining the fund to prevent a default on other exchanges. And the beautiful part, from their perspective, is that retail investors in SLV had no idea it was happening. The share price was bouncing around with the spot price. Everything looked normal on the surface. But underneath, the physical bars were being quietly siphoned out to keep the system alive. Let's stop here and make sure we're all on the same page. Here's what we know so far. The price of silver crashed 40% in late January. The mainstream narrative says this was a rejection of value, that the speculators got flushed out, that the market is back to normal. But the vault data tells a completely different story. Lease rates are at historic highs, 6.3% as of Friday, February 6th. That's a signal of desperate physical demand, not oversupply. SLV was drained of 35 million ounces between late December and late January. The banks were redeeming shares to get physical bars, which they then used to settle contracts on COMEX and in London. The March delivery wall is 4 times larger than the available registered inventory. If even a fraction of those contract holders stand for delivery, the vaults will be empty. And delivery requests in the first 5 days of February match the entire volume of February 2025. So let me ask you this. Does that sound like a market that crashed because of oversupply? Or does it sound like a market where the physical shortage is so severe that the banks had to orchestrate a price collapse just to shake out the leveraged longs before the whole system imploded? Now, I know there are people watching this who are thinking this sounds too conspiratorial. If there was really a shortage, the price would be going up, not down. Let's Steelman the skeptic position and address it head on. Skeptic argument number 1, the smart money sold. Bian Chiming, the gold king, built a 30,000 contract short position and made a $288 million paper gain. He wouldn't do that if a moonshot was imminent. Fair point. Bian Chiming is a legendary trader. He's got resources, intelligence networks, and trading acumen that most of us can only dream of. If he's short, shouldn't that tell us something? Here's my rebuttal. Bian's short position was a brilliant trade in the paper market. He read the setup perfectly. He knew the margin hikes were coming. He knew the over-leveraged longs were sitting ducks. He positioned accordingly and made a fortune. But here's what his short position doesn't do. It doesn't create physical silver. It doesn't add a single ounce to the COMEX vaults. It doesn't reduce the delivery backlog in Shanghai. It doesn't lower the lease rates. All it does is force lower leveraged longs to liquidate their positions, which crashes the paper price. And crashing the paper price is exactly what the bullion banks needed to happen. Because if the price had kept climbing toward $150, $180, $200, the delivery demands would have accelerated even faster. The vaults would have been completely drained. The entire fractional reserve system that underpins precious metals pricing would have been exposed. Bian's short position, intentionally or not, gave the banks the breathing room they desperately needed. Here's another argument I hear constantly. The CME raised margins because the market was getting too volatile. That's just responsible risk management. Let me destroy this myth right now. The CME didn't raise margins by 47% because they wanted a fair fight. They raised margins because it's the only kill switch they have left to stop the physical drain. When you raise margin requirements, you force out the smaller, more leveraged traders. They either pony up more capital or they get liquidated. Most of them get liquidated. And when those liquidations happen, the price crashes. Stops get triggered. Panic selling kicks in. And suddenly, the narrative shifts from silver shortage to silver bubble bursting. But here's the thing. If the margin hikes were really about risk management, they would have been implemented gradually over time as volatility increased. Instead, they came in a massive, coordinated spike right at the moment when delivery pressure was peaking. That's not risk management. That's market manipulation. And if you think margin hikes are a sign of market health, explain to me why lease rates are still spiking after the crash. If the smart money were right about a surplus, borrowing costs would be falling, not rising. The lease rate is the truth serum. It can't be manipulated with margin calls or short attacks. It's a pure function of physical supply and demand in the vault system, and it's screaming shortage. What happens next? So where do we go from here? Let me walk you through the most likely scenarios and the indicators I'm watching. Scenario 1, force majeure or cash settlement. If the March 1st delivery notices exceed the 103 million ounce registered inventory, the COMEX has a few options. They can declare force majeure, basically a contractual escape clause that says extraordinary circumstances beyond our control prevent us from fulfilling delivery. Or they can shift to cash settlement only, meaning contract holders get paid in dollars at the current paper price instead of receiving physical bars. Either option would be an admission that the system is broken. It would destroy whatever remaining confidence exists in the paper markets, and it would likely trigger a massive surge in physical buying as people realize the vaults are empty. Scenario 2, another coordinated price smash. The banks could attempt another round of margin hikes and coordinated short attacks to force even more liquidations before March 1st. They could try to drive the price down to $60, $50, wherever they need it to go to shake out the remaining longs. But here's the problem with that strategy. Every time they crash the price, physical demand accelerates. Retail buyers see $70 silver as a gift. Industrial users step in to lock in supply. Sovereign buyers increase their accumulation. The lower the paper price goes, the faster the physical vaults drain. It's a death spiral. Scenario 3, a slow bleed. Maybe the banks manage to thread the needle. Maybe they drip feed just enough physical metal into the system to keep deliveries moving without triggering an outright default. Maybe they convince a few big longs to roll their contracts forward instead of standing for delivery. If they pull that off, we could see a slow, grinding recovery in price over the next few months as the shortage continues to build but doesn't quite break the system. This is actually the scenario I'm least worried about, because a slow bleed gives me more time to accumulate physical at reasonable prices. Here's my dashboard for the next 3 weeks. Indicator number 1, March 1st delivery notices. If delivery requests exceed 100 million ounces, I'm viewing that as a broken market. The COMEX will be forced to make a choice, and neither option is good for them. Indicator number 2, SLV total shares outstanding. If the outflows continue at the current pace, we could see another 20 to 30 million ounces leave the fund by the end of February. That would put total outflows since December at over 60 million ounces. At that point, SLV becomes a zombie ETF. The physical backing is so compromised that it's no longer a reliable proxy for silver exposure. Indicator number 3, lease rates moving toward 10%. If we see lease rates break above 10%, I'm personally assuming the vaults are functionally empty, regardless of what the official inventory reports say. 10% is the point where even the banks can't afford to keep playing this game. The carrying costs become unsustainable. And here's something I want you to notice about the timing. Every time the banks manipulated the SLV discount or engineered a price crash, it was followed by a massive surge in physical demand in Shanghai. The Chinese market isn't stupid. They know what's happening. And they're using every Western price smash as an opportunity to drain even more metal out of the LBMA system. Here's my prediction for how the narrative will evolve over the next month. Right now, the mainstream media is running with the silver bubble has burst. They're interviewing analysts who predicted the crash. They're dunking on the retail traders who bought at the top. They're reassuring everyone that price discovery is back. But as the March delivery wall approaches and the inventory numbers start getting really uncomfortable, the narrative will shift. It won't be, the vaults are empty. It will be supply chain disruptions. You'll start seeing headlines about mining delays, refining bottlenecks, logistics challenges. Maybe they'll blame a strike at a major mine. Maybe they'll point to geopolitical tensions affecting shipping routes. The goal will be to explain the physical shortage without admitting that the pricing system is fraudulent. And the beautiful part, from the media's perspective, is that most of those explanations will have a grain of truth. There are always some supply chain issues in commodities. Mining is never perfectly smooth, but they'll use those real issues to obscure the much bigger problem. The paper market has been running a fractional reserve scam for decades, and the reserves are finally running out. Watch for it. All right, let's talk about how I'm positioned and what I'm planning to do based on what I see over the next few weeks. First, let me be clear, this is not advice. This is me sharing my personal plan as a 12-year veteran of the physical silver market. You need to make your own decisions based on your own research and risk tolerance. Here's what I'm doing. Trigger 1, I'm watching the March 1st delivery data like a hawk. If the delivery requests exceed 103 million ounces of registered stock, I'm viewing that as confirmation that the market is broken. At that point, my expectation is that the COMEX will either declare force majeure or shift to cash settlement. And if that happens, I'm increasing my physical holdings significantly. Not paper silver, not SLV, not futures contracts, physical bars and coins in my possession. Because once the COMEX breaks, the premium on physical over paper is going to explode. We could see $10, $20, even $30 premiums per ounce as retail buyers scramble to find metal. Trigger 2. If silver lease rates in London break above 10%, I'm personally assuming the vaults are empty, regardless of what the screen says. At that point, the paper price becomes meaningless. It's just a number on a screen that has no connection to physical reality. And I'm not waiting for the media to confirm it. I'm not waiting for some official announcement. I'm acting on the data. Trigger 3. If silver breaks back above its January high of $121, I'm viewing that as confirmation that the crash illusion has failed. The banks threw everything they had at this market. Margin hikes, coordinated short attacks, media narratives. And if the price climbs back above 121 anyway, that tells me the physical demand is so overwhelming that even their best manipulation tools can't contain it anymore. At that point, I'm looking to increase my physical exposure even further because we're likely entering the final parabolic phase. However, and this is important, if I see COMEX registered inventory start to climb significantly this week, I'm sitting on my hands and waiting for a deeper washout. Because if the banks somehow manage to replenish the vaults, it means they found another source of physical metal. Maybe they convinced some big holders to sell. Maybe they imported a bunch of bars from somewhere. I don't know, but if that happens, it buys them more time. And more time means more opportunity for another coordinated smash. In that scenario, I'd rather wait for $70 or even $60 before adding to my position. Here's the mental framework I'm using to navigate this market. We're transitioning from a market of price to a market of possession. For decades, the paper price of silver has been the dominant signal. If you wanted exposure to silver, you could buy SLV or futures contracts or mining stocks, and you'd get essentially the same return as someone holding physical bars. Sure, there was always a small premium on physical, but it was negligible, a few percent at most. That paradigm is breaking down. As the vaults empty and the fractional reserve system gets exposed, the premium on physical possession is going to explode. We're already seeing it in the retail market. Dealers are quoting $4, $5, $6 premiums over spot for physical bars. And that's when they have inventory, which is increasingly rare. But that's just the beginning. If the COMEX breaks, if the LBMA can't meet delivery obligations, if the lease rates go parabolic, we could see a scenario where the paper price is $70, but you literally cannot buy physical metal for less than $100. At that point, the paper price is just a psychological anchor. It's what the banks want you to believe silver is worth. But the real price, the price that actually clears the market, is whatever it takes to pry bars out of the hands of people who already own them. And those people are not selling at $70, the sovereign wildcard. There's one more factor I haven't mentioned yet, and it's potentially the biggest one. Sovereign buyers, China, Russia, India, and several other nations, have been accumulating physical silver and gold for years. They understand that the Western financial system is built on paper promises, and they're quietly positioning themselves for the day when those promises break. If a major sovereign buyer decides to stand for delivery on a large COMEX position, or if they simply start buying physical at a pace that exceeds the available supply, the entire system could collapse in a matter of days. And here's the thing. We wouldn't necessarily know it was happening until after the fact. Sovereign purchases are often routed through proxies. They're not required to disclose their positions in real time. By the time the data becomes public, the vaults could already be empty. This is why I'm not trying to time this perfectly. I'm not trying to buy at the exact bottom. I'm focused on possession. Because when this thing breaks, you're not going to get a nice, orderly opportunity to buy physical at paper prices. You're going to wake up one morning and the premiums will be 30%, 40%, 50% overnight. And if you're sitting in SLV or futures contracts, hoping to swap into physical later, good luck with that. If you want a historical parallel for what I think is about to happen in silver, look at what happened in the bond market during the 2023 banking crisis. For years, everyone assumed that U.S. Treasury bonds were the most liquid, most reliable asset in the world. They were risk-free. You could always sell them at the quoted price. And then Silicon Valley Bank collapsed. Suddenly, banks that were sitting on billions of dollars in Treasury bonds couldn't sell them without taking massive losses. The quoted price was one thing. The actual bid, the price someone was willing to pay in real time, was something else entirely. The illusion of liquidity evaporated. Silver is the same situation, except with an even thinner physical market. The paper market quotes $77, but can you actually buy 1,000 ounces of physical bars at $77 today? Go ahead and try. Call a dealer. See what they quote you. I'll wait. The spread between paper and physical is the crack in the foundation, and it's widening every day. Here's the scenario that keeps me up at night. Right now, the physical shortage is mostly confined to industrial users, bullion banks, and sophisticated investors. Retail buyers are trickling in, but it's not a stampede. But what happens when the mainstream media finally catches on? What happens when CNBC runs a segment on the silver shortage? When Bloomberg publishes a deep dive article on the empty vaults? When some viral TikTok video explains the comics delivery crisis to 50 million people? Retail panic buying could overwhelm the system in a matter of hours. Every coin shop in America would be stripped bare. Online dealers would shut down their websites because they can't fulfill orders. Premiums would go parabolic. And at that point, the paper price becomes completely disconnected from reality. You could have silver trading at $80 on COMEX, while physical bars are changing hands at $130 in the real world. This is not hypothetical. We saw exactly this dynamic play out in March of 2020, when the COVID panic hit and physical premiums spiked to $12 over spot. But that was a temporary liquidity crunch. The vaults weren't actually empty. This time, they are. Let me share the calculation I made back in December that convinced me to increase my physical position. I looked at the total above-ground silver supply. Best estimates put it around 2 billion ounces of investment-grade silver in various forms: bars, coins, ETFs, vaults, private holdings. Then I looked at the total amount of investable capital in the world: stocks, bonds, real estate, cash, everything. Call it $500 trillion, conservatively. If just 0.1% of that capital, that's 0.1%, decided to move into physical silver, we're talking about $500 billion of demand. At $77 per ounce, that would be 6.5 billion ounces. But there's only 2 billion ounces available. Even if you assume half of that demand goes into paper products like SLV or futures, you're still talking about 3 billion ounces of physical demand against 2 billion ounces of supply. The math doesn't work. And that calculation assumes a tiny incremental shift in capital allocation. If we get a real flight to safety, if pension funds, sovereign wealth funds, or institutional investors start rotating even 1% of their capital into physical silver, the shortage becomes catastrophic. This is why I'm not worried about whether I bought at $70 or $80 or $90. If the thesis plays out, the difference is noise. I know a lot of people watching this are wondering, when does this actually break? Is it March 1st? Is it later this year? Is it 3 years from now? Honest answer, I don't know. The banks have more tools and more resources than I can fully account for. They've been managing this system for decades. They know where the pressure points are. They know how to shift metal around, how to manipulate sentiment, how to buy time. But here's what I do know. The trend is irreversible. Global silver production is roughly 1 billion ounces per year. Industrial demand alone is around 900 million ounces per year, and it's growing because of solar panels, EVs, and electronics. That leaves 100 million ounces per year for investment demand. But investment demand has been averaging 300 million ounces per year over the last decade. The deficit is structural. It's not going away. And every year that deficit continues, the above-ground supply shrinks. The buffer gets smaller. The system becomes more fragile. The banks can manipulate the price. They can engineer crashes. They can shake out weak hands. But they can't create physical silver out of thin air. And eventually, the math catches up. Here's why I'm not losing sleep over the possibility of another price crash. If they smash it to $60, I buy more. If they smash it to $50, I buy even more. Because every dollar lower they push the paper price, the faster the physical vaults drain. It's a game they can't win. Lower prices don't solve a shortage. They make it worse. And at some point, whether it's March or June or next year, they're going to run out of physical metal to deliver. When that happens, the paper price becomes irrelevant. The only thing that will matter is possession. And I'd rather own the metal at $77 and watch it go to $60 before going to $200 than to sit in cash waiting for the perfect entry and miss the break entirely. The final breakdown of trust. Here's the endgame as I see it. This isn't just about silver. It's about trust in the entire financial system. For decades, people have operated under the assumption that the price you see on the screen represents reality. That if the ticker says silver is $77, you can buy or sell at that price. But that assumption is breaking. We're entering a world where the screen price and the real price are two different things, where the quoted inventory and the actual inventory are two different things, where the official narrative and the truth are two different things. And once that trust breaks, once people realize the vaults are empty and the prices are fake, there's no putting that genie back in the bottle. This is why I think the March delivery wall is so critical. It's not just about whether the COMEX can physically deliver the metal, it's about whether the system can maintain the illusion of legitimacy. If they declare force majeure, if they shift to cash settlement, if they admit they can't meet their obligations, that's the moment when trust collapses. And when trust collapses in one market, it spreads to others. If silver futures can't be trusted, why would you trust gold futures, copper futures, oil futures? If the COMEX can't be trusted, Why would you trust the LBMA or the Shanghai Exchange? The contagion risk is enormous. I want to end this with something personal. My family knows I'm into silver. They've watched me stack for 12 years. They think I'm a little obsessive, maybe a little paranoid, but in the last few weeks, I've had more conversations with them about this than ever before. And here's what I'm telling them. I don't know if this breaks in March or later this year or 3 years from now, but I know the system is broken. I know the vaults are draining. I know the math doesn't work. And I know that when it finally breaks, there won't be time to react. You won't get a news alert that says, silver shortage confirmed, you have 48 hours to buy physical. You'll wake up one morning and the dealers will be sold out. The premiums will be astronomical. The paper markets will be frozen. And if you don't already own the metal, you'll be priced out. So I'm telling them, don't wait for proof. Don't wait for the mainstream media to confirm the shortage. The vault data is the proof. The lease rates are the proof. The SLV drain is the proof. It's all right there if you're willing to look at it. Let me pull this all together. The $77 price you see on the screen is a paper mirage. The real story is in the vaults. And the vaults are screaming shortage. 35 million ounces drained from SLV while the price was crashing. Lease rates spiking to 6.3% despite a 40% price collapse. Delivery demand running at 4 times the normal pace. The March delivery wall is 400 million ounces against 103 million ounces of registered inventory. The banks manipulated the paper price lower to shake out leveraged longs and buy themselves time. But they didn't solve the shortage. They made it worse. And now we're in the final countdown to March 1st. Either the COMEX delivers or they admit they can't. Either the vaults hold or they break. Either the illusion survives or it collapses. We are moving from a market of price to a market of possession. The vaults don't lie, even when the charts do. And the vaults are telling you, in the clearest possible terms, that the physical metal is vanishing. I don't know what the paper price will do tomorrow or next week or next month, but I know what the lease rates are doing. I know what the delivery data is doing. I know what the SLV outflows are doing. And all of those signals point in the same direction. You can choose to believe the screen or you can choose to believe the vaults. I made my choice 12 years ago, and I'm stacking harder now than I ever have. The situation is evolving hour by hour. The data I'm seeing this morning could be completely different by tonight. The March delivery notices could start rolling in any day now. The lease rates could spike even higher. This is not a static situation. It's a rapidly developing crisis. And if you want to understand how we got here, if you want to see the full picture of the Shanghai inventory collapse and the global supply chain breakdown that set the stage for this moment, you need to watch my previous breakdown. Go to the channel, find the Shanghai video, watch it now, because the pieces are all connected. And the more you understand about how the physical markets in China, London, and New York interact, the better positioned you'll be to navigate what's coming next. I'll be watching the March delivery data. I'll be tracking the lease rates. I'll be monitoring the SLV outflows. And when something significant breaks, you'll see it here first. This is the kind of intelligence that most market participants won't understand for weeks or even months. You're getting it now. Use it wisely. The vaults are speaking. The question is, are you listening?